Hello, my name is Christy Marina, and this is a mini case of capital structure for Lyons Solar Technologies. Question 1. Who are Modigliani and Miller? They're two professors who studied the theory of capital structure intensely in the 1950s. They published papers that created a new outlook on financial leverage and also won Nobel Prizes in economics for their work. Their analysis is extremely complex, but under certain assumptions, the basic idea is it makes no difference whether the firm finances itself with debt or equity. What are the basic assumptions in and Miller models? That firms can be grouped into similar classes according to the business risk. There are no transaction or agency costs. There's symmetry of firms' future earnings between companies and investors. There's no effect of debt on a company's earnings before interest and taxes. All cash flows have zero growth, and earning before interest and taxes is constant over time, and all debt is risk-free, and an unlimited amount of money can be borrowed at the risk-free rate. In question 2, we're to find V, S, RS, and weighted average cost of capital for firms U and L, with both having earning before interest and taxes of $500,000. U uses no debt financing and cost of equity is 14%. L has $1 million in debt and cost of 8%, and there are no taxes. And for value, since under the assumption of no taxes and both firms have the same earning before interest and taxes, therefore the value of the companies are equal to each other, which result in $3,571,429. For S, the market value of a firm's debt and equity is $2,571,429. RSL is equal to 16.33%, and weighted average cost of capital is 14%. Question 2 continued. Graph the relationship between capital cost and leverage and the relationship between value and debt. On the left-hand side, the capital cost and leverage relationship, we can see that as debt increases, the level of risk for equity also increases, which creates higher costs. RD and weighted average cost of capital are constant. On the right-hand side, the relationship between value and debt, we can see that the value of the companies is the same of $3,571,429. And we can see with the analysis that under zero taxes, the value of the firm is unaffected by debt and remains constant as debt increases. Question 3, assume firms L and U are both subject to a 40% corporate tax rate and repeat the analysis, finding V, S, RSL, and weighted average cost of capital. As we can see, considering corporate taxes, the value of the companies in this example are different. The value for company U is $2,142,000, and the value of company L is $2,542,000. S, the market value of L's debt and equity is equal to $1,542,857. RSL is equal to 16.33%, and weighted average cost of capital in this example, considering corporate taxes, is 11.80%. In question 3, we're to graph the relationship between capital costs and leverage and also the relationship between value and debt considering corporate taxes. On the left-hand side, we can see with the analysis that RSL increases with debt at a slower rate when corporate taxes are considered. And the weighted average cost of capital for L is lower than U when subject to corporate taxes. On the right-hand side, with the relationship between value and debt, we can see that when considering corporate taxes, the firm's value of L remains constant, and the firm's value of U increases continuously as more debt is used. Question 4, suppose investors have the following tax rates: TD 30%, TS 12%, and TC 40%. Part A, what is the gain from leverage according to the Miller model? L's firm value increases with debt, so for every $100 increase in debt, it raises the value by $25. In Part B, how does this gain compare to the gain in the model with corporate taxes? We could see that for every $100 increase in debt, it raises the firm's value by $40 rather than $25. So the gain from corporate taxes is higher than the gain from personal taxes. In Part C, what does the Miller model imply about the effect of corporate debt on the value of the firm? Personal taxes lower the value of debt financing to the firm. However, corporate tax laws favor debt financing over equity financing because interest expense is tax deductible while dividends are not. So this provides an incentive for firms to use debt financing. Question 5. What capital structure policy recommendations do the three theories, MM without taxes, MM with corporate taxes, and Miller suggest to financial managers? And empirically, do firms appear to follow any one of these guidelines? So under MM's theory, the capital structure recommendation for a zero tax assumption is that the capital structure is irrelevant to the value of the firm. With corporate taxes, the value increases, so firms should use close to 100% debt financing. Under Miller's model, with personal taxes added to the analysis, the value still increases, but less than under the MM theory, and firms should still use close to 100% debt financing under the personal tax theory. So Miller's theory is the most realistic among the three. However, most firms use about 40 to 50% debt financing on average. We did see that in the 1980s, firms were increasing their debt, so they were moving more towards the Miller theory, but since the 1990s, firms have decreased their debt. Question 6 asks, how is the analysis in Part C different if firms U and L are growing? If a firm is growing, then all the assumptions under MM are broken. The MM model demonstrates how growth affects the value of the debt tax shield and the cost of capital. One difference can be seen when the appropriate discount rate for the debt tax shield is the unlevered cost of equity and not the cost of debt. And we can see this with the non-growing value of the firm being $2,142,857 and the value of the growing firm being $3,571,429. Another difference is a growing debt tax shield is more valuable than a constant debt tax shield. And with the non-growing debt tax shield, the percentage was 18.7%. With the growing debt tax shield, percentage was 12.80%. So the smaller the tax shield, the greater the value. Question 7 asks, what if L's debt is risky? And if L's debt is risky, then there is a possibility that the company will default on payment. The decision to make payment or default on debt is similar to a decision on exercising a call option. For example, let's say L's equity is considered as a call option with an exercise price of $2 million and an expiration date in 1 year. If the firm pays off the debt when it matures, then the equity holders will get to keep the company. However, if the value of L's operations is less than $2 million a year, then the firm will not be able to make the required payment on the debt and can face bankruptcy and losing everything to debt holders. In question 7 continued, we have an example of using equity as an option under the Black-Scholes price. On the left-hand side, the data was given, and we were to use that information to find the value of equity, which resulted in $2.196 million, the value of debt, which is $1.804 million, and the yield, which is 10.89%. And this is all with a volatility level of 0.60. Question 8, what is the value of L stock for volatilities between 0.20 and 0.95? As we can see, as volatility increases, the value of equity increases, but the value of debt decreases. And if we look under volatility column for 0.60, which was our example in question 7, we can see that the value of equity is 2.20 and the value of debt is 1.804, which matches our results in question 7. Question 8 continued. What incentives might the manager of L have if she understands this relationship, and what might debt holders do in response? Well, managers have incentives because they can change a firm's volatility by choosing to invest proceeds in riskier assets, but inform debt holders that they are investing in different assets, which is known as bait and switch. By changing volatility, wealth can transfer from bondholders to stockholders. The action decreases the value of the debt because the transfer is riskier. but it increases the value of equity because although stockholders can potentially default on the bonds, their rewards can be limitless. As a result, bondholders can demand a higher rate of return to compensate them for the risk, or they can just simply refuse to do business. And that is the end of my presentation. Thank you so much.